Hey guys, it is Julie here with JT Wealth. In today's video, we are taking a look at a few different ETFs that will help give you exposure to 3 exciting sectors. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we are going to take a look at some different ETFs if you're looking to get some exposure to some very hot sectors right now. These sectors include the travel industry as it recovers from this pandemic, the EV industry and green energy, and then another type of green company as the MJ sector. And just before we get into all of that, this is just your friendly reminder that if you enjoyed today's video, make sure you give us a big thumbs up and leave your thoughts in the comments down below. Also, if you like free stocks, make sure to check out some of the links in our description. Right now, Webull is giving away 4 free stocks for signing up and funding your new investment account, so make sure to check them out. Okay, so first off, why would you choose to invest in an ETF versus investing in a specific stock? Well, with an ETF, you have that built-in diversification as you're getting exposure to a magnitude of stocks, all normally within a specific sector or target. And that diversification also leads to a lower risk exposure as well, as any poor performing stock is often balanced out by others that are performing well. And one other key benefit is that these are professionally managed. So if you don't have the time to constantly be watching and rebalancing your portfolio, with an ETF, you have that team of managers helping do that for you. We are going to start off by looking at ETFs in the green energy and EV sector, as we know both are booming lately and it seems there's a new EV maker on the market every week. First up, focusing on the green energy space, is the First Trust NASDAQ Clean Edge Green Energy Index Fund under the ticker QCLN. They currently are at about $61.90 and have an incredibly impressive year-to-date return of about 147%. They also have a nice expense ratio at 0.6%. This ETF tracks the NASDAQ's Clean Edge Green Energy, which is tracking US-listed pure-play companies active in the clean energy market, including renewables like solar and wind, energy storage, and electric vehicles. Looking at their current top holdings, the top 2 spots are occupied by EV companies NIO and Tesla. We also have a couple big energy companies in there like Plug Power and Brookfield Renewable Partners. The second ETF that we're going to look at focuses a bit more on the electric vehicle sector itself, and that is the Global X Autonomous and Electric Vehicles ETF under the ticker DRIV. Currently $22.83. They have a year-to-date total return at 54.42% and a net expense ratio at 0.68%. The Global X Autonomous and Electric Vehicles ETF seeks to invest in companies involved in the development of autonomous vehicle technology, electric vehicles, and EV components and materials. So this includes companies involved in the development of autonomous vehicle software and hardware, as well as companies that produce EVs and EV components such as lithium batteries and critical EV materials such as lithium and cobalt. This Driv ETF is said to have an unconstrained approach, as their composition transcends classic sector, industry, and geographic classifications by tracking an emerging technological theme. And in a single trade, Driv delivers access to dozens of companies with high exposures to the autonomous and electric vehicles theme. Taking a look at their top 10 holdings, we have a lot of recognizable names. Number 1, of course, being Tesla. We also have Apple and Alphabet or Google. NIO is in there as well, Toyota, General Electric, Microsoft, all really big names. So by holding this one ETF, you are getting exposure to some pretty big companies, all doing some very exciting things in that industry right now. The second sector that we're going to take a look at is going to be in the travel sector, as we know that this year's pandemic took a massive toll on these companies as a lot of their stocks hit a new bottom. But now with talks of a successful vaccine coming to the market, people's hopes are renewed in this industry as the road to recovery is now possible. Now the first ETF that we're going to take a look at, I'd say is fairly well known in this sector, and that is the US Global JETS ETF under the ticker JETS, currently at $23.29. Now their year-to-date daily total return is a negative 26.55%, and you can see on that chart there the massive dip that they took at the beginning of 2020. We have seen some recovery already since those lows back in March, but are still a ways off from our 52-week high of $32. Now, the road to recovery is not going to be an instant one, but it still can represent an interesting opportunity. The JETS ETF provides investors access to the global airline industry, including airline operators and manufacturers from all over the world. Looking over on the right to their industry breakdown, you can see that majority of this ETF is in the airlines, with their second largest positions being in transportation infrastructure and transportation. By country, you can see the bulk is within the United States, but there is good global exposure as well. Looking at their top 10 holdings, no surprise here, these are all very big recognizable airline companies, including United Airlines, American, JetBlue, my personal favorites being Southwest Airlines and Delta. The second ETF in this sector gets away from the air travel and focuses more locally on different entertainment and leisure companies. And this is the Invesco Dynamic Leisure and Entertainment ETF under the ticker PEJ, currently at $38.28. Again, we do have a negative year-to-date total return to be expected for sure. This ETF is based on the Dynamic Leisure and Entertainment Index and is comprised of common stocks of 30 U.S. leisure and entertainment companies that are principally engaged in the design, production, or distribution of goods or services in the leisure and entertainment industries. Looking at their September 30th fund facts, they are mostly based here in the United States with a bit of exposure to China and the UK. Their biggest sectors are hotel, restaurant and leisure, and entertainment and media. At the time, their top holdings were companies like Domino, Fox, Chipotle, Walt Disney, and even Penn National Gaming. As of today, their top 10 have shifted slightly, with the new top positions being Viacom, Cisco, Walt Disney moving up there, along with Yum Brands. So once we have a vaccine officially approved and people can begin going out and enjoying these types of entertainment and restaurant companies, we could see a lot of growth come back to this sector. Now, the third sector that we are looking at is another type of green company that if I address too directly, YouTube might get mad at me. So I will refer to as the MJ industry. Now, this sector is getting a lot more attention lately as our president-elect is deemed to be a lot more friendly when it comes to this topic, and we're seeing more and more states legalize or decriminalize this product. First ETF we are looking at is Advisor Shares Pure ETF under the ticker YOLO, currently at $16.34 with a year-to-date daily total return at 23.66 and an expense ratio at 0.75%. YOLO seeks growth opportunities by investing in equities of U.S. and foreign MJ-related companies engaging in legal business. The portfolio manager uses a fundamental investment process to identify related companies across multiple industries with dominant positions in their respective markets, as well as companies in unique positions for upside growth and expansion. Additionally, the actively managed YOLO can adjust its portfolio more quickly than a passive index-based strategy, an important attribute in a rapidly evolving marketplace. Their top 10 holdings include Village Farms International, GW Pharmaceuticals, Afria, Arena Pharmaceuticals, many big names in there. Second up is another actively managed MJ ETF, which is the Amplify Seymour ETF under the ticker CNBS. Currently $17.39. They have a year-to-date daily total return at 8.16% and an expense ratio also at 0.75. CNBS boasts that it will only hold companies deemed to be abiding by the federal laws within the countries they operate, and they will hold a basket of companies diversified by industry, market cap, and business focus, which helps to mitigate single stock risk. Worldwide consumer spending on MJ was up 45.7% in 2019 just from 2018. It's currently legal in some form in 47 US states and 21 countries, with more anticipated to come. In their top holdings, there are a lot similar to the previous ETF with GW Pharmaceuticals and Afria, but we also have some different ones in there like Canopy Growth and Charlotte's Web Holdings. Now, this sector certainly involves a lot of risk as there's a lot of uncertainty that still lies ahead. And this is where an ETF can really become handy if you're wanting to get some exposure, but don't feel like rolling the dice on picking one of these companies. By having a large pool of them, you're going to get the benefit when one or any of them do really well. So those are just a few examples of the many ETFs out there that'll help you get some exposure to some of these very interesting and exciting sectors. As always, you guys know I love hearing from you. So please let me know your thoughts on ETFs in general versus investing in specific stocks, what you think of these ETFs, and what some of your other favorites are. Make sure to leave your thoughts down below in the comments. Of course, these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Any investment choice should always be made after your own due diligence and research. If you made it all the way to the end of today's video, make sure you give us a big thumbs up and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a wonderful day, and cheers.